Hey guys, Nicholas Coriano here with Servitude Intelligent Relations. Let me show you guys the shirt here so you guys know where we're at. Today we're going to discuss the value of a shell company. So for the purposes of this video, we're talking about a public shell company. And usually people are shopping public shell companies because they're looking for a reverse merger or they're looking to become publicly traded without an IPO via a reverse merger. So basic economics dictate the value of a shell. First, supply and demand, how many shells are in the market. More commonly, they're not being called shells due to the regulatory factors. A lot of time they're operating companies with minimal assets or minimal revenue, and they're willing to be sold off to a new venture. So let's go over a few things. I got 6 points here that kind of dictate the value of a shell, and these things range. So I've seen shells go for all equity deals, meaning the buying company doesn't put anything up. It just has a really good revenue model or assets that the existing company doesn't mind holding on to some stock after the reverse merger. And I've seen them go up to $1 million for a clean reported trading shell. So, but here's a few things that matter. Number one, how it was created, and I'll go over these a little bit in detail after I list them off, right? So number one, how it was created. Two, whether it has assets or liabilities. Three, whether it's trading or a non-trading shell. Four, whether it's reporting or non-reporting shell. Five, the size of its shareholder base. And six, whether it's clean or unclean. And I'll go over these now. So one, the creation of the shell. So shells are created in several ways. Sometimes shells are created where they actually list the company on, let's say, an over-the-counter market, freshly traded, has no operations, and then it becomes a shell. Or it becomes a shell from the get-go. Others are created after bankruptcy, right? They go through a bankruptcy process. It ends up becoming a shell company after all the assets are sold off. So the creation determines the value of the shell because obviously if you have a newly freshly created public company, there's less issues. There's less skeletons and clauses, for lack of a better word, as opposed to when you have a bankruptcy. You have a lot of litigation, pending litigation maybe, or issues that could pop up in the future. So how it was created will determine the value. Whether it has assets or liabilities, this is pretty simple and straightforward. Some shells have assets like cash, land, properties, and some have liabilities along with those assets. Now, depending on how many assets and liabilities will depend on the value of the shell. Most commonly, what you're going to see with shells is, and this is just a broad stroke line. This is not, a blanket statement, but generally with a lot of shells that are, call them under $500,000, you're going to see a lot of liabilities. And some of these liabilities come from the prior management that has notes payable on the books, or they may come from suppliers or past business practices. And the more liabilities, obviously, the cheaper the value of the shell because you're taking on those liabilities when you take on the company. Another one is the trading or non-trading status of a shell. So the more trading, the more liquidity in the shell, obviously the more value. It's easier to get funding for a public company when it is liquid. If it is illiquid, it has less value. Next point, whether it's reporting or non-reporting. So this goes on the tier basis. If it's a non-reporting shell, you're probably going to be in the pink sheets or the gray market. If you're a reporting shell and you're up to date on your fees, depending on where you're trading, they're going to be valued higher, right? So penny stock is going to be valued less than an OTCQB, which is going to be valued less than an OTCQX, which is going to be valued less than a NASDAQ or a New York Stock Exchange, which don't generally have any shells trading on them. But again, this depends on all the other factors as well, right? You can have a totally trading reporting shell on the OTCQB with $1 billion in liability, and it's going to trade maybe lower than something that has less liability. So keep that in mind. Next size, the size of the shareholder base. So the size of the shareholder base matters because what you really want is liquidity when you're going into a public company vehicle, whether you're trading on the New York Stock Exchange or the NASDAQ. What you want is to be able to trade in and out of the stock. Management wants that. Investors want that. And this is part of the reason why you go public is liquidity. So the size of an existing shareholder base will determine the value of the shell company. And then the last one is whether it's clean or not clean. When they say whether it's clean or not clean, what we're basically saying is, does it have any pending lawsuits? Does it have any skeletons in the closet, right? So a clean shell, usually there's nobody filing suit on the company. There's no issues with any past filings or any SEC regulations. It's in full perfect standing with the regulators as well as the stock exchanges. That's a clean shell. An unclean shell would be something where, like I said, maybe there's a lawsuit, or maybe there's from shareholders there's a lawsuit, or maybe there's a lawsuit from suppliers, or maybe there's an infringement. They have a copyright infringement, trademark infringement on another company. So, or they're filing suit, right? The suit doesn't only have to be coming this way. It could be that it's filing suit somewhere else. So basically, it just makes it messier to clean up when you get in there as a new CEO after a reverse merger. But these are some things, these are 6 things that you should consider when you're valuing a shell. If you want to learn more about this, I write more about it on our blog at servitude.com. You can check us out at servitude.com. I also recommend a great book by called Reverse Mergers by David Feldman. Really good book. It'll teach you a ton about reverse mergers and shell companies, and give you some other tips on what to look out for. If you are in need of an investor relations firm, we've helped hundreds of companies develop their business plan, their IR strategy, their online marketing strategy. Reach out to us at Servitude. Hope this video was helpful, and share it with somebody if you think it was.